Hello, welcome back. In the previous two episodes of this three-part series, we discussed the CFTC case against Total Energies and the ASIC case against Macquarie Bank, who were ordered to pay a record 4.9 million Aussie dollar fine for failing to prevent suspicious orders being placed in the electricity's futures market. In this last and final episode of the series, we'll be discussing another ASIC case, this time involving JP Morgan. And I will be leading us through that, so I can hand it over to myself. So this involved a infringement notice that was filed from ASIC, which I just kind of liked that terminology, that's how ASIC has kind of deemed these. I found that interesting. And this was a $775,000 Aussie dollar fine, which they assessed for market gatekeeper failures, which will sound very familiar from our last episode involving Macquarie. And this is related, again, to a DMA client who was potentially manipulating the close in ASX for Australian wheat futures. And that fine was kind of instigated by the market disciplinary panel in Australia. When reviewing this, that kind of led me down a bit of a rabbit hole into Australian financial regulation civil procedure and exactly what this markets data disciplinary panel is, which is kind of something I've kind of read about in a lot of these ASIC cases, but hadn't actually looked into or, how they are kind of providing it. And I think it's, at least to my knowledge and understanding, it's relatively novel setup they have for providing these fines. So in Australia, they still have the standard process where they can have, criminal proceedings, and ASIC can actually bring criminal charges, similar to the FCA in the UK, civil proceedings where, actually, bringing them to court and seeking, disgorgement of funds and large monetary penalties. But for ones that are, these ones are kind of, I seem to them kind of call it this, but obviously it's kind of slightly lesser severity. That's where they have these infringement notices, and where it does involve, the market disciplinary panel, they can, actually bring it to this panel, and they will have full hearings where they will kind of decide the fines and whether or not they actually should be.
So why is that different?
This notice.
So that sounds very similar to like the CFTC enforcement process, no? Where you have like this private, like determination of what the penalty is.
Yeah. So the main difference is that it's actually made up of market participants, effectively.
Oh, so they're not. Oh, interesting.
Yeah, so you have people from, I'm kind of looking at my notes, what they call it. Their members are comprised of persons with significant market or professional experience. And they actually list out all of the members that are on the markets disciplinary panel at the current moment. So there's people from Barrenjoey, someone from Macquarie, who are actually sitting on these panels and deciding it. And I think they kind of, obviously there'll be some conflicts and things that would arise, so they kind of have to pick a panel of three people who are kind of not conflicted to the entity that they're kind of looking at and bringing this notice against, and they will ultimately decide whether or not to issue the notice and kind of factor in and give the fine, and throughout the process kind of give their rationale and reasoning for actually bringing the fine. So I thought that was interesting. I'm not aware of, I'm sure there's probably, there may be in some other smaller jurisdictions, but in the other major jurisdictions, there isn't this kind of peer review panel who are kind of deciding fines for market, infringement.
I'm sure you'll get into it as you explain the case, but you mentioned the fine was $775,000
Yep.
for manipulating the close. In the previous episode, we spoke about it was $5 million for what is perhaps the same underlying behavior. I think in episode 1 it was $48 million, but it was slightly different. It was benefiting the existing position. I mean, how do they come up? Feels like small change, no? $775,000.
Yeah, and I mean, and again, so this is much more analogous to the Macquarie example because it is not the trading activity wasn't by JP Morgan itself. This was a DMA client. So this is purely a supervision issue. But I think, they actually, and also I'd say the ASIC kind of the MDP infringement notices are really quite detailed too, in terms of they have a full breakdown of the fine amount calculation methodology, and in terms of like, all right, how many infringements are there, the severity of them, and then depending on that, they kind of have a band essentially of kind of like how many, I can't remember what they actually call them, but they call them almost kind of like penalty
units
points
or something.
Yeah, penalty units. I think that's the one. And then that kind of aligns to how much the fine actually is amounting to. So in this case, it was fewer instances than the one in Macquarie, but it's effectively kind of the same type of activity.
And what was the pattern exactly?
So again, quite a similar pattern where, so again, as I mentioned, this is involving the Australian wheat futures market. And
I think last time Shane gave us a very helpful explanation of how electricity was generated. It was very detailed.
Yeah.
And maybe I learned a lot. Maybe we need something similar in this episode around wheats. And
like
tell
sow
me
the
more,
seed,
Andrew.
and then you need to water it, and that's very important.
I hear talking to them helps. No, if you talk to your plants, it helps them.
Yeah,
exactly.
Classical music, isn't it?
Yeah. Unfortunately,
but
I don't. Yeah.
Australia is a big wheat exporter in seriousness. I looked it up, 30 million tons a year. So that's 3% of global wheat production. Australia does not contain 3% of the world's population, so they are, a big wheat exporter.
Yeah.
But unlike power markets, I don't really feel like the wheat futures are that liquid. Like, I don't think we're getting 30 million tons of, each future I think is 20 tons or something. Is that right?
Yeah.
And you're talking about thousands of these things trading, but you're never going to add up to even 1 times the physical volume, I don't think. Is that right?
Yeah. And I think even they mentioned that in the in this case, the customer of JP Morgan was at times making up like almost 100% of the trading volume. Because it's really fairly illiquid stuff. I should have mentioned there is a separate, unlike the Macquarie one, there's a separate proceeding going on against Kofco, who was the JP Morgan customer who was executing this manipulative strategy, and that is still kind of an ongoing, not an infringement notice, but going through the process for a proper civil.
What are they? Are they like a speculator, or are they
the best? It's kind of
company?
like Chinese Cargill, if that makes sense. So it's like a massive kind of agribusiness in China that is involved in kind of all aspects of kind of different agricultural products.
And correct me if I'm wrong, Andrew. So, the reason that case is presumably ongoing is because, and just like in the Macquarie case, we don't absolutely know. It's not a matter of fact that manipulations occurred. It's a matter of fact that there's been some supervisory errors, right? And that therefore a suspicious pattern of trading was not kind of self-reported. But we have, no court has tested whether or not the actual trades themselves were done with the intent of being manipulative.
Yeah, exactly. But the as with many of enforcement infringement notice, there are comms in this one, which are a bit damning for the Kofco argument, I would say. So just in terms of quick bit of background. So very similar to the Macquarie case, where they were trading around very much, a lot of trading activity right in towards the close, with a daily settlement price can actually, be determined off of, a single bid at some points, which is, or a single offer, I should say, that is, at a better price than where the last trade was. This is what they were doing. They were kind of a pattern of, I think, 50 instances or so, where they were putting these kind of bids and offers in very late into the market, and then impacting the daily settlement price. And then they're kind of this was a pattern that was picked up by ASIC as part of their review across the futures market. They brought it to JP Morgan, asked them, have you kind of identified this pattern? Have you kind of had any issues with this? Have you kind of brought this to investigated it? They hadn't pick this up or, and as part of their own kind of internal reviews, but did start a dialogue with COFCO as the customer, kind of ask them, well, what are you doing? What is this trading pattern? We're kind of getting questions asked of us by ASIC. They're investigating it. And that's kind of where the difference is. I think from the Macquarie case, we're kind of saying this, whether or not it is manipulative is kind of important, but maybe not necessarily proven. Whereas in this one, they kind of almost point a bit to the information they received back from that JP Morgan received back from COFCO as kind of essentially kind of evidence, not of manipulation, but at least their intent to kind of breach market rules by trading in this manner. So, just in terms of what they actually, brought up to them, and they asked them why they were building, trading in this way. They mentioned they had a very large short position that they had built. And the economic rationale for the trades was that they were protecting a short position from another party bidding up the close by entering bona fide sell orders executed within the bid offer spread. And they put that in the email to JP Morgan. Unsurprisingly, the JP Morgan.
Exactly the Neil Phillips Morgan Stanley case, that was, like, I think he's in jail now, but that was his rationale there was to protect.
He's not in jail.
He
He got no custodial sentence, but he was found guilty.
He was found guilty.
Yeah.
Okay.
I suppose it's the inverse, though, isn't it? So I think the allegation against Neil Phillips was that he was pushing a price to a barrier,
so that he would.
Right. Whereas here is someone defending against a margin call. So it's the opposite in terms of, they're saying, wait a minute, someone else is trying to push the price around and I'm trying to stop them. But that still seems that you are essentially saying the purpose of your trading is the resultant price move, which feels quite dangerous ground to make your defense on, I would say.
Well, given the whole thing is not to create a price that isn't a true reflection of supply and demand, right? Like you are trying to get a price through a level.
This is the second episode in a row where we've talked about the manipulation of daily settlement prices and therefore the margin consequences of them. And they're both on ASX. And I think, Shane, you gave a bit of a introduction to the way the daily settlement price is calculated for energy with some kind of VWAP, but it allowed for the introduction of orders if there were very competitive orders in the close too. And we looked at that and we thought, well, maybe there's some problem with volumes on that, which makes this easily manipulatable. I think the settlement process for the week contracts is even more vulnerable, I would say. So this uses the ASX 24 operating rules to define how the settlement price is determined, and it's essentially got a big waterfall of potential ways of calculating the settlement price under certain criteria, and as soon as one of these works, then that's the settlement price. So the first thing they'll say is, like, is there a bid offer that's within $20 or something a ton? If there is, at the end of the day, then just average the bid and offer, and that's the DSB. And if that fails, then they will say, is there a bid which is greater than the most recent traded price? If there is, that bid is the DSB. If there's an offer which is less than the most recent price, then traded price than that. And then, okay, if that isn't true, then it will say, well, maybe there'll be another one. Maybe it'll be the most recent trade price. Maybe there'll be a series of fallbacks. Now, the interesting thing here is you can imagine that if there was one trade only, so you've got this reference trade price out there, and there's really no action in the order book, and you just put an offer for one contract. As long as no one executes on it, you get to choose. You get to choose what the DSB is, right? And you're not really hazarding very much because you're doing it in size 1.
Yeah. Wow.
But look, obviously, like, it's pretty easy to point this out, but these rules are probably designed very carefully. The fact is, these rules are a response to presumably low trade volumes, and you know what else is a response to low trade volumes? The diligence of ASIC. Bringing cases like this, and like the case against Macquarie, bringing cases to show that they're aware that low trade volumes can make DSPs vulnerable to manipulation, and they expect gatekeepers, therefore, to behave in a judicious way.
Mhm.
But it is, it does, it's worth a read if anyone's got, spare 10 minutes on a commute or something to dip into the ASX 24
two-day flight
operating
chain.
rules.
There
Yeah.
No, that kind of struck me as well too, in terms of how kind of, if you do have a good understanding of it, you could kind of very much see, there's a good way for me to kind of avoid. But like you said,
I suspect actually a good way of spotting people who are potential market manipulators is just seeing who's downloaded these DSP calculation rules.
Yeah, we're all going to get in trouble there. The three of us are going to be
straight on a watch list, right? I mean, anyone
I'm
who's
about
dissected...
to hit the border. I'm about to hit the border now.
But anyone who's dissected the rules, I suppose, they could be doing it as a white hat or as a black hat, couldn't they?
Yeah.
And
That's funny. Yeah.
It was in terms of the, like you mentioned, the liquidity on it. I think they were 100% of the volume on several of the days in question. So it kind of struck me though, when we mentioned in the previous case too, like we're surmising around, well, who we don't know from the quick case who was actually the one trading, doing this activity, versus here we know who it is, and it's this kind of massive multinational with I think they have 60,000 employees or something like that. So
why is this customer allowed to be named?
Well, so they're not named in this proceeding with this infringement notice from JP Morgan, but there is a separate case that ASIC has announced against them.
I see.
And if you kind of look at the details, it's obvious that it's kind of the exact same.
As a conspiracy theorist, you've done the digging, right, to join
exactly.
the dots. Yeah,
I've
you've
kind
got
of
the
put it
map
together.
in your room.
So, as someone who's not a conspiracy theorist, just bring it back to numbers. I looked through the facts here. The allegation here is that there was a manipulation of the daily settlement price to defend a short position, right? And the largest size of
that's my view. So
that's what
they
said.
Say,
I mean,
the client said, didn't they say there was some?
Didn't they say that they were defending? They were defending against someone who's trying to bid up.
Yeah,
and they had a big short position that they were trying to defend.
Yeah. So, but I guess you're right. They didn't explicitly say, because we're gonna get a margin call on it. But yeah.
Yeah, but I mean this is not a cash settle contract. This is a physically settled contract. So at the end of the day, they're going to have to deliver some wheat regardless. And I don't, well, let's get to the comparison between the cash and the physical markets. The liquidity isn't in the futures market. The liquidity is in the physical market for wheat. So I don't think that the price is being set by the futures market because the volumes are so much smaller. Yeah. So in the long term, they have to deliver some wheat. That's all, right? They've got a wheat future, physically settled. So their only motivation really can be to manage the margin. And if you read through the paper, then they say their maximum short position was 2,600 contracts. Mm-hmm. Now, a contract is 20 tons. So that's, 50,000 tons. They're short 50,000 tons of wheat. And I think later on, they say that on average, their behavior depressed the daily settlement price by $10 a ton or $9.99 or something. Mm-hmm. So, I mean, it feels like, okay, they're managing to, keep hold of $500,000 Aussie dollars of margin. Mm. And you think, okay, well, maybe if they were a day trader, and
they're not.
They're at their kind of credit limit, and they've maxed out their Amex, and they've got no way of making the margin, but they really believe that position's going to come back, so they just need to hold on. But this is, you just described this as a multinational firm, 60,000 employees, presumably an enormous balance sheet. It feels like I don't see what the victory they're extracting. So, but 500,000 of margin. What's the overnight cost of that? It's like $100, is it?
Yeah. And I mean, they do in the Kafka ASIC case. They do. This is just one trader, so it is the same person doing this each time through them. So I don't
So
know.
you think, well, this is someone who's a bit out of control, and they don't want to have to tell their boss they've lost $500,000. They're a junior trader or something,
Yeah.
and so they're just trying to control the price that that their account's going to be based off almost.
They're just trying to find any alpha, any edge they can get to kind of make their P&L look as good as it can.
$500,000 better.
Yeah.
Yeah. I mean,
when was this taking place? Like what month?
Well,
Just out of
2000.
curiosity.
So this was December to February 2022.
Comp season, no?
I knew that's where you're going. Yeah.
This is like that. Maybe he was trying to those numbers.
But if these guys were 100% of the market at various points, and their maximum position is 50,000 tons, and then you compare that to the annual production in Australia of 30 million tons, it really shows you that this is not, the physical market's dog is wagging the futures tail, not the other way around here.
Yeah.
I don't think that this mispricing in the futures market is going to result in physical commodity being traded at the wrong price. I can't imagine that.
Yeah.
No, it is actually, it's a bit of a tangent, but there was a 2015 case against Kraft, the kind of huge U.S. food producer who, they produce like Cheerios and all these kind of, cookies and things in the U.S. So they unsurprisingly buy an insane amount of wheat to turn into flour. And they were talking about how, and it's an interesting case of kind of interested in wheat futures contract manipulation, where they were talking about how they basically purchase all of their wheat through the cash market because it's much higher quality. So they kind of get into like how many insect infected kernels you can have per 100 grams, and the level for futures delivery wheat is.
I like Cheerios. Don't tell me this.
Well, they're buying it through the cash. They're buying the good stuff. But and like mycotoxins and things like that. So the acceptable levels for futures delivered wheat is much higher than. And, obviously in the cash market, you can kind of, that's basically what they kind of bargain around in terms of like, well, how many, insect infected kernels per 100 grams is going to be in this wheat.
The Kraft, which is the huge multinational, Kraft Heinz or whatever they're called now, they are just buying wheat like spot when they need it. Like there's no
2 months worth on hand at all times they have.
No, but you're saying that they're buying it in the futures market. That's what you're saying, because
no, they're not buying in. Andrew's saying it. They don't, because the delivery through the futures is of such poor quality.
Oh, really?
That's
bad. Oh, well, I suppose
farm doors or something.
You are going to deliver the worst quality you can get away with, right? So whatever the specifications of the contract are.
Maybe the specifications, it needs to be tightened up. No,
but well, wait a minute.
No,
let's not lump everyone together. Presumably, they weren't talking about the ASX wheat. Eastern Australian wheat future.
No, this was
was Chicago or something.
SRW or whatever it's called. Yeah,
exactly. This is specific to the U.S., but I mean, they came up with this scheme where they realized that if they actually showed kind of like tipped off to the market that they had built this massive long position in the futures and they were actually going to take delivery of it, that they could kind of move around, narrow the spread between the cash and the futures market and make a ton of money, and like basically just put this into emails like to the manager, like, this is a great like strategy. We're really like crushing it this month. And obviously that didn't work out so well in the CFTC got a hold of that. But it kind of goes in, because I think it was a bigger case, it kind of goes into a lot more detail around. I imagine it's probably going to be the same thing in Australia, where you're going to have much higher quality and much more liquidity in the cash market, because I think pretty much all of the Australian wheat is then sent to like Indonesia and South Asia to all these massive kind of milling companies who then use it to kind of produce flour for baked goods and things of that nature. So a bit of a tangent into kind of how the cash to wheat market works, but I thought it was kind of interesting nonetheless. But
so comparing this to the previous case, it sounds very similar, and it sounds like maybe the main difference is the way that the bank responded when ASIC reached out. Is there anything else that jumps off the page as a differentiator?
I think the main differentiator is the fact that the customer, and this came back and kind of you know, basically
That they what
admitted
they were
to
doing, yeah.
to kind of manipulating the market. And I feel like then after they kind of got that, then was it's kind of open and shut a bit. I do like that they kind of mentioned like, oh, these were bona fide trades, so they kind of at least were thinking in like the mindset of what is market abuse, spoofing,
Well,
that kind of
I don't
thing.
know if that's like running someone over and saying, yeah, it was fine for me to drive like that, right? Like, you just because you say it doesn't mean it's not.
And also
the market and be like, yeah, well, it was bona fide. Yeah.
That defense has been tested numerous times in court. I mean, maybe not in Australia, I don't know, but definitely in the US, where someone said, well, look, they were real orders. Someone could have traded on them if they wanted to.
Yeah.
But that's no one's suggesting that a spoof order is somehow like a phantom. It's not an illusion, right? If you were fast, you could still interact with it.
Yeah.
I mean, the allegation is that it is not really reflecting your intention.
Wasn't your primary motive.
Yeah. Your exactly. Motivation was to create a picture about supply and demand rather than to trade.
Exactly. And it doesn't, you're kind of saying, oh, my intent was to kind of, keep the price down artificially with these bona fide orders. It doesn't quite align because, well, you just said that your intention was actually for not, not to.
Well, and if they were bona fide orders, you would be wanting the price to drift up.
Exactly,
because then you'd be able to sell at a better price, right?
Exactly.
I mean, and it's interesting too. I mean, in the ASIC document, they do compare the actions of this trader in the period where they were building their short position, where I think their typical order size was more substantial, with their typical order size during this period where they were trying to defend their position, where it was much smaller, focused around the close. So very, two distinct behaviors, right? One where they're actually trying to access liquidity, one where they're trying to, create a contrivance.
Yeah.
That's the allegation.
Yeah. I really, I liked from the kind of infringement notice and way the MDP kind of breaks down in terms of, all right, you have this kind of standard where you, should have reasonably suspected that this customer was manipulating the market. And then they kind of lay out basically this test of saying, well, what should you have examined and how do those impact the market, and figure out whether or not this was reasonable or not. And, kind of very much speaking the trading hump language, a lot of the points they speak to kind of what was the market impact, what was your, creating artificial level of supply and demand, which I mean aligns to the Corporations Acts and the laws in Australia. But some of the ones that kind of brought up, I thought were really kind of interesting. They kind of highlighted as, whether the execution order would alter the market for the price of the contract, whether the order or the execution was inconsistent with their kind of normal trading patterns, whether the orders were series of orders were unusual, having given the kind of normal size and the trading activity, and whether or not there was a legitimate commercial reasoning for the trades to be executed. And they kind of go through those one by one and in the order kind of examine the trading activity from this customer, how JP Morgan should have kind of been evaluating this in the context of, does it seem like reasonable activity, yes or no? Granted, there's also kind of them saying that we're trying to manipulate the close, but
the big one there is like their activity related to their own normal, like if they were trading in size at other times of the day. But is that what you're saying? That related to themselves, there was an outlier in behavior?
Yeah. So I mean, typically they're putting in these kind of larger, well, relatively larger than kind of they're putting in these single lots, right? Next to the close, versus their size. They're normally trading intraday is much larger. That doesn't kind of make sense. What is how are the orders or trades kind of altering the market? I think that seems to one they focus on a bit the most too, in terms of, and this wasn't even like kind of a massive liquid market where kind of impacting it hugely, but again, some of Macquarie, you can kind of see like, well, here's kind of how we view this and would have impacted this daily settlement prices, which is used for, kind of knock-on effects that kind of have a lot of quotes too, in terms of then wheat futures, how farmers use that, how people are going to be feeding their families, et cetera. So kind of a lot of knock-on effects to then when if you are kind of trying to manipulate these closing prices in the wheat futures market.
So I think these have been three interesting cases. Any favorites out of them?
The case of the episode.
No, the cases. I mean, I asked the question because in many ways, both of these ASIC cases are quite similar and quite straightforward, I think, in terms of detection, potentially. I mean, they're all to do with one contract.
Yeah.
And
one order book.
All you need to do is to understand that single order book. And so I think there's probably a wide range of vendors who can help with that, for instance. I think this is a well understood problem set. I think for me, the TOTSA case is potentially intellectually more interesting because it involves this kind of more subtle interplay between physical markets, the details about how they settle, etc., and that's implications on a related financial derivative. It's certainly more challenging to chase through, but also potentially more profitable if you can pull the abusive strategy off, right?
Yeah.
But there are interesting points about all three cases, I'd say.
I'd say I learned just kind of out of purely intellectual curiosity into the electrical grid. I learned a lot from the Macquarie grid, though, which I kind of found.
Well, Shane's explanation of magnets and wires was very compelling. Compelling.
Well, there you go. Next time you'll think of it when you flick a light switch on, right?
Yeah, it was one of those things you just kind of take for granted, and at the halftime of the England game, I can turn on my kettle. But exactly.
Yeah, but I agree. I think the TOTSA case was interesting, I think, because it was transparent, where you could see the futures versus the physical, and obviously the CFTC was open about that. I mean, there are also cases that we've seen where there is order book manipulation happening because that daily settlement price is used as reference pricing for other transactions, for example, which we've seen. So I think actually it's, of the three cases, I think TOTSA is probably the most interesting, but I would say this, thinking about an order book in the context of what it's being used for a variety of other things is something, a lens that we should be exploring further, I think.
And I think, maybe the most interesting case has not yet been bought yet, isn't it? Like, so, what would be a good opportunity for that kind of physical versus cash manipulation were you so minded? Maybe it's hard to do, but you've just been very clear, Shane, in the ratio of derivative to physical that exists in power markets. So there's an awful lot of futures trading of, relatively speaking, smaller quantity of physical trading. And there are auctions for physical capacity, like dynamically, which will be then used to affect the settlement of those derivatives. Well, exactly. And, I mean, you don't have to think that far back in time to remember Enron, for instance. I mean, presumably that temptation still exists.
Yeah.
No?
But as I said, I think that's all we have time for today, unfortunately. And I think this is the conclusion for this 3-part series, looking at different cases in the commodities market. So thanks, everybody. Please join us next time for a new topic. Thank you.
Thank you.
Bye-bye.